Along with my day job running an investment business, I started Tinsley Park Talks, a global networking and leadership platform where I interview industry legends from finance to tech and great thinkers to notable celebrities. In these interviews, we discuss great ideas around investing, entrepreneurship, problem solving, and all other lessons of life. Welcome to another episode of Tinsley Park Talks. Take a moment to please subscribe to the channel and like this video. We really appreciate your participation. This program is in partnership with Nesh. For more information, please click on the link below. Steve Westerback is a partner at Atlantic Pacific Capital, or APC, one of the largest privately owned placement agents and advisory firms in the world. Having completed over 130 capital raising assignments and raising over $100 billion since 1995, APC is clearly one of the leading firms in the industry today. Steve leads the firm's Secondaries practice, which has been a growing segment for the firm in the recent years. In this episode, Steve and I will discuss the rise of the secondaries market and how it's shaping the private equity industry. Away from his Manhattan office, Steve joins me from the Great Plains of beautiful Montana. Steve, welcome to the show.
Thanks, Najib. Great to be here. Thanks for inviting me to be your guest today.
Oh, it's a pleasure. Before we talk about where you are, because obviously, it's not a typical place. I've done an interview with someone, but I want to just talk about how we know each other. So, Steve, you and we worked together a couple of years ago. I had the good fortune of working with your firm and yourself when I was launching Tinsley Park Partners, and it was a ton of fun working with you. And so it's always good to have people come to the show that I have known personally in the past and have worked professionally as well. So thanks again for joining.
And likewise, it's been a pleasure working with you as well. You know, we've had some good experiences together. We've done an international roadshow together. We've been in front of a number of institutional and investors, and it's great that I could join you today from Montana.
Yeah, no, it was very fond memories I have of that. That was like when I was just stepping into being an entrepreneur and starting something on my own, and then we met and everything just kind of worked out. So it's a very fond memory. So I wanted to bring you back to talk about what you do. But before we do that, really like to know what you're doing, where you are. Tell our viewers what's the background.
Yeah, you just happened to catch me during our annual firm offsite week. So Atlantic Pacific Capital, where I'm a partner, we come out to our chairman's ranch every year. We look forward to it with great anticipation. It's one of those events that you don't find a lot of firms have the luck of having a resource like this available. But Jim Manley built out this ranch, which is a 5-star rated ranch out here in Montana. It's a luxury resort. And so we're spoiled to a great extent when we're out here. It's a lovely place. He's got thousands of acres. We've got, full herds of cattle out here, 70 or 80 horses. We were just out horseback riding earlier this afternoon. It's a fabulous place to be. And when we come out here, we bring our entire team from offices globally. We have about 40 of our colleagues here with us this week. And we use that time both for team building, but also to celebrate the successes over the past year, a number of, really fabulous closings that we've been involved with across the firm, but also to plan ahead and to think about the future. And so it's kind of a work hard, play hard type mentality we bring when we're out here, but allows us to kind of clear our heads and really focus on the business that we're trying to build and how we can continue to deliver value to our clients.
Yeah, that's awesome. I'm jealous. I wish I could be out there with you right now in Montana.
It's a good spot, and one of the I guess features of having the ranch available to our firm is that it's a huge recruitment tool as well. I can't tell you the number of people that hear about our firm and they love the fact that we bring our entire global team together here, and that leads to a lot of inquiries and a lot of interest in joining the team as well. So that's been a real added bonus.
That is super cool. What's the farthest somebody had traveled from to there? I know that you guys have office in London and other places far east.
Yeah, well, we've got people here from Dubai. We have a number of colleagues here from our Hong Kong office. So there's people, really that have come from all over the world to to be here, not just New York, where I happen to be based.
So Steve, I know you mentioned that building a team for you has been a very rewarding experience at APC. I know when we worked a couple of years ago, you're maybe a year into your role, I think. And then since then you've had tremendous growth and success. Do you wanna share with us how that journey has been for you so far?
Yeah, so I came on board to Atlantic Pacific Capital to build a secondary advisory team. And prior to that, the firm's real legacy has been as a primary placement agent, raising capital for financial sponsors, raising private capital funds across different sectors. That could be buyout funds, infrastructure funds, private credit funds. And that continues to be a very strong business for us globally. But I came in to focus on the existing assets part of the equation, working in some cases with those same sponsors, but also with others that have portfolios of existing assets. And they may be looking for an opportunity to raise incremental capital around those companies. They may be looking for an opportunity to accelerate liquidity and provide distributions back to their investors. And that's really where I come in. So we've grown the team today from, when I started the business a few years ago. We now have upwards of 20 people at the firm that are focused in some way on secondaries. And that's a huge component of our team. It's not just a US focus, but it's global. And really one of the differentiating factors that we bring to our clients is that we're not just focused on a subset of the institutional investor base. We're focused on traditional investors that are increasingly looking to participate in our secondaries. Some of those will only look at single asset deals. Some will look at multi-asset deals. Some of them will look across. Some of them will participate on a primary basis with one of our GP clients, and some will look to participate exclusively on a secondary basis. But in any case, we've got a large net that we've cast out into the market that's really considerably larger than what we see a lot of our competitors are doing in the market. And that's just been a huge tool in helping us win business in the current market, really focused on building those long-term investor relationships for our GP clients.
Awesome. And we are talking about the secondaries market today, so you are the perfect person for that. You lead the secondaries practice for APC, and we're gonna dig a little deeper into that. But before that, I think the audience would love to know your upbringing. Do you want to take us back to where you're originally from and how'd you get to your undergrad program at Muhlenberg School? Did I pronounce that correctly?
Yes, you got it right. That is my undergrad. I did, kind of spent my undergrad years focused on economics and accounting, not too dissimilar to other people in finance. And then coming out of Muhlenberg, went to work for an investment bank in your traditional analyst program. Spent 3 years at Citigroup, learning kind of the nuts and bolts of financial analysis. I focused specifically on mergers and acquisitions transactions across a host of industries. And through that experience, ended up spending a number of years over in London. Initially was meant to be a long-term assignment, and ended up establishing residency over there, for a number of years before ultimately coming back to the US to get my MBA. And then it was from
MBA at Harvard. Let's just drop the Harvard name. There you go.
That's correct. And then moved over to actually the buy side of private equity coming out of Harvard Business School. And that's where I went, really to apply the skills I had developed in my investment banking years towards making investments, to be able to diligence and underwrite investment scenarios and write investment committee memos and become part of the investment committee decision-making process. I did that before ultimately then moving over to the advisory side, where I've been now for, 15 plus years at this point on the advisory side of the business, working with clients, both limited partners looking for liquidity, and really the last few years focusing largely on general partners, the private equity fund managers themselves, around existing portfolio positions and creating value for those investors.
Did you know that your company's most valuable assets are the knowledge stored in your experts' minds and the content they've created over the years? These assets form the foundation of successful teams. When experts go on vacation, move teams, go on parental leave, retire, or resign, your teams find themselves in the dark, resulting in onboarding delays, quality loss, burnout, and drop in customer satisfaction. Nesh revolutionizes this for you. Nesh turns subject matter expertise into subject matter avatars to preserve this knowledge. Nesh connects all of your company's content, turning treasure troves of data and knowledge from your experts' minds into precise, searchable answers. Nesh is made for simplicity, where you can ask a question in natural language. It's just like interacting with a colleague. She improves continuously to become the ultimate subject matter expert for your organization. With Nesh, use your knowledge as a superpower to bring innovative products to market, grow business blazingly fast, and provide an extraordinary experience to customers. Unleash the power of your enterprise's most valuable asset with 24/7 available subject matter avatars. Excellent. Now, you did mention what the Secondaries group does at APC compared to the traditional primary capital side. But I just want to simplify it a little bit more for some audience that may not know the primary versus secondary. And you said this very eloquently earlier. What you guys do is you provide the fundraising, heavy lifting, and basically which is a very arduous, difficult task, raising capital from institutional investors. You are essentially hired by a private equity fund or a private credit fund or any kind of alternative investment fund, for that matter, to really help them get either new institutional investors in a new fund, or a fund 2 or fund 3, and you guys do that. But usually when you go traditionally raise a fund for these private equity funds, it's known as the primary fundraising avenue, because you have a track record in place, and as a general partner, and you're hiring a placement agent like Atlantic Pacific to raise subsequent funds, so they don't have to go and do all the hard work. But then there's been this rise of the secondaries market in the last few decades. I'd like to hear from you, sort of, why was the secondaries market born first, in addition to this primary market that existed, and then how has that evolved till where we are today?
Right. So what you've been talking about in terms of the primary side of the business, and also it gets into the secondary side, that's what we call capital formation, or what the industry calls capital formation. And so that initially wasn't a big part of the secondary market, but it's increasingly important today. When I started in secondaries, including in my prior buy side role, there really wasn't an established GP secondaries business. Most of the secondaries business, I worked for a GP, I was a member of the investment committee, but we were looking at buying out limited partnership interests in variety of private capital funds.
Like pension funds and endowments, those types, right?
Exactly. So institutional investors that were looking to reallocate positions across their private capital portfolios in what essentially is a illiquid asset class. And so we would come along and provide valuations or pricing around various pieces of their portfolios where there was potentially interest to transact. Many of those transactions are done on a competitive basis, but sometimes you find transactions that are not managed through a competitive process. But in any case, buying up positions in private capital funds and essentially taking on that ownership and that future capital commitments for those funds. And that's been the where the secondary market originated from. That's where most of the historic volume has come from. But it's really been, say in the last 5 years that you've seen this dramatic rise in secondaries as a tool for the general partners of the private capital funds themselves, where they're looking at the secondary market as a way to kind of enhance their existing portfolios of assets. And that's been, a huge boost to the business that my firm is involved in, but also to the industry more broadly.
Right. So what you're saying is traditionally it was very much a solution for mostly just LPs like these endowments and pension funds. But over the last few years, you're seeing more and more general partners, private equity funds that are also using the secondaries vehicle to really, I mean, get liquidity for their investors, right? And to be able to exit maybe quickly than they maybe otherwise could have exited.
So liquidity is a very important component of these transactions, but it's not the kind of dominant theme in every case. So I'd say I work on, as many secondary transactions that are about raising growth capital to continue allowing, individual portfolio companies to generate value for investors. And that's equally an important part of the equation as providing liquidity back to a private equity manager's portfolio.
Correct. And I think that's why you're seeing, as you said, more and more GPs that are accessing the secondaries market and I think we have a case study that would demonstrate why. So Steve, can you share some examples of a GP-led transaction, a structure and different characteristics, perhaps?
Yes. So for every opportunity we get to talk to a GP about what options are available in the secondary market, we always want to be careful to understand what their objectives are and not to force a cookie cutter transaction structure on any GP. There are certainly some structures that have gained a tremendous amount of momentum. Think about your typical continuation vehicle transaction. We could talk about what that is, but those are extremely popular right now, but they're not the right solution for every GP. And so one of the things that my team really emphasizes is understanding what the objectives are, how to prioritize those, and then think about how to customize what a transaction can ultimately take the shape of. I found myself recently completing a balance sheet recapitalization for one portfolio company in a private equity manager's portfolio. And by recapitalizing the entire balance sheet, both from an equity perspective and a debt perspective, we were able to position that company to execute on a number of add-on acquisitions over the coming years. And not just from the typical equity investor that you think of in a secondary transaction, but also by simultaneously allowing that portfolio company management team to expand on their banking relationships, their traditional banking relationships, and expand their debt syndicate so that they now have the opportunity to use debt capital as well as equity for future acquisitions. And that having both of those types of, or both sides of the balance sheet, effectively reset, that gives them a lot more flexibility in terms of the acquisitions they can take on in the future. So that's kind of how we like to think about a GP-led transaction. We start with what the priorities are before we get into the actual structure itself.
Excellent. Steve, we have a couple of cases to cover here. One, do you want to talk about the first case, the staffing deal that you guys, single asset structured deal?
Sure. No, I'd love to tell you about that deal. That's a recent deal that the team here just closed, and we're very proud of the work we did with our private equity fund manager client on that transaction. Essentially, the manager was looking at a situation where they had invested in the company about 4 years ago, the initial platform asset through their fund, and they had reached a critical mass where there was concentration in that fund and there was not capital available to continue investing out of that same fund vehicle to continue adding to the value of that investment. And so historically, our client had gone back to a number of its LP investor relationships to source capital for add-on acquisitions and had done that a number of times. They had closed on at least 8 add-on acquisitions before Atlantic Pacific got involved. And so that was a successful way of doing it. But at the same time, they looked at the history with this platform. They had started with single-digit EBITDA as the entry performance of the company when they first made the investment. And today that is closer to 50 million of annual EBITDA. And they recognized that there was a limit on how many times they could go back to their existing investor base and continue to ask for additional capital for that same asset. It had become one of the GP's single largest assets in its portfolio, if not its largest asset. And at the same time, the majority of capital that had now come from co-investors was being raised without the benefit of the GP receiving management fees and carried interest on that capital. And so they had thought long and hard about They had scaled the asset up, and it was potentially a good time to sell the asset. They had received a number of proposals to buy out the asset in the weeks and months before Atlantic Pacific got involved in the situation, but they recognized that a large part of the reason they were thinking about exiting the asset was because they just didn't have readily available capital, in their purview. And so when we talked to our client about, well, why not leverage the secondary market? We could raise additional capital for you for growth. And if there are investors that are looking to take some liquidity, some of the earliest investors that had supported the manager, we could help with that as well. And that's just what we did. We took the deal to the market. The market over the last few months, has been a bit choppy in terms of there's more scrutiny on assets, and we could talk about the overall market scenario. But This was a case where, really we wanted to meet the GP's objectives around this asset, and we did it through structure. And differentiating from your typical structure that you see in the market. So we did recapitalize the entire balance sheet of the underlying portfolio company, but we also implemented a different security, a different equity security, more senior for the new capital that we were bringing in, replacing the original equity security that was taken out through a partial distribution to all investors. Also, in terms of the liquidity that we provided, it wasn't your traditional option where, like in most continuation vehicles, you allow each investor to decide how much are they selling or not selling in a company. In this case, after extensive consultation with members of the LPAC and with the LPAC's full support.
And LPAC is Limited Partner Advisory
Committee. That's right. So typically the most prominent investors, the largest investors in a private equity manager's fund, that are involved in some of the key decision making, especially around important transactions like we were talking about, and they had supported what amounted to returning original cost basis to all investors, and so that was something that was fixed up front, and it was something we were able to use when going out to investors in the market. It wasn't some arbitrary number that was subject to change after a lengthy election period with investors. But in this case, investors that we talked to about introducing new capital to the asset, they knew what the minimum size of the liquidity component would be because it had been agreed with the manager in advance. And that was, a very positive attribute as well, having greater certainty around what the transaction size would be. And that allowed us to focus more on the growth capital component of the transaction, raising capital for future add-on transactions and providing that additional runway to the manager to continue investing and doing add-on acquisitions over the next 18 months or 2 years or so until the manager is ultimately ready to exit the asset entirely. And at that time, it's expected that the company's operating performance would be substantially larger than it was at the time we first started working on this transaction.
If you can shed a little bit of light on the new set of governance that came along, or lack of it maybe, in this new structure, that would be great.
Yeah, so the governance itself, it's not all that differentiated. It's the manager retains full control of the asset, but we put the new capital, including the new replacement capital, into an SPV that sits alongside the main fund. We were not in a position where we needed to move it to a new standalone vehicle, because the alignment with the initial fund where the asset was first invested from was quite strong. There was not a difference of timing from an exit perspective that would mean that the new investors and the existing investors were not going to have a similar time frame in terms of exit. They both, I think I mentioned, the asset was about 4 years old at the time that we got the deal completed. So there was still more time left in that existing fund, and certainly creating a side vehicle that allows the GP another 2 or 3 years of time to continue managing out that investment, that just aligns very nicely with the initial fund vehicle.
Got it. Great. Okay, and I believe you have another example of a deal, which was a strip sale. Do you want to expand on that?
That's right. So just as much as we work on single asset deals, the market continues to have a lot of appetite for multi asset deals. Multi-asset deal can be 2 assets, 3 assets, 4 assets. In the example that I wanted to share, Najib, it was really providing liquidity across a portfolio of 7 assets in an older vintage fund managed by the GP. They had successfully been distributing capital over the last few years as opportunities arise, but also felt that maybe they were, not at the level of distributions that they would like, particularly as they're thinking about raising their next fund, and wanted to make sure that they were doing right by their LPs and sending capital back, but didn't want to feel undue pressure to exit a portfolio company or 2 prematurely, especially if there was a clear value creation plan in place for those assets over the next year or 2. And so what we did was sell broad exposure across the entire fund portfolio for the GP, and that allowed new investors to come in to get instant diversification, to come in at an attractive valuation, but simultaneously be sending back a significant distribution to investors that were already in that fund, but not so much where they weren't going to share meaningful portion of the future upside in those assets. And so I think you see that these types of transactions do have traction. A lot is going to come down to what the makeup of that portfolio that's being sold looks like. Sometimes you've got assets that are more larger components of the transaction, so greater concentration risks, but other times it's spread more broadly. It really just depends on what the outlook for that particular portfolio compensation looks like. But in many cases, it can be a good way to bring a GP new investors. In both cases, we introduced the GP to significant numbers of new investor capital. And that's one of the hallmarks of Atlantic Pacific and our team, is that we tend to focus more on traditional investors, not solely the most active secondary investors. So our GP clients get a good mix of being in front of different types of investors. And across both of those 2 case studies we're talking about, Atlantic Pacific brought capital in from numerous traditional investors, groups like family offices, multifamily offices, traditional asset managers, primary fund of funds, investors, and so forth. And those were viewed very favorably from our GP clients, in that they expanded their LP rosters.
Sorry, the traditional investors opposed to like buy-side secondary funds?
So when I say traditional investors, I mean traditional private equity investors. So groups that are typically supporting general partners either at the time of raising their next funds or for single asset situations, single new investments. And I'd say that to differentiate investors from your more active secondary investors, groups that tend to focus only on secondary situations, but may not be interested in looking at a GP's primary fund when those become available, or new single asset investments when those become available through a GP's platform.
Got it. Okay. I want to switch over to the current market conditions. Obviously, impossible to ignore the last year of rising rate environment, inflation, now geopolitical tensions between China and the US, and you're a global firm. How do you reflect on where the market is today for secondaries, given all those factors?
Yeah, so we try not to get too bogged down in the short term. My firm, Atlantic Pacific, we've been around for almost 30 years at this point, and we've seen the market through all different kinds of cycles. There are slow periods, and then there are more ebullient periods, and there's nothing different about what we're seeing in the market today. But part of the differentiated approach is that we're trying again not to force certain structures on our clients that may not be receptive in the market today. And I think by using structure to either through a preferred security or having a different equity security that's more senior involved in a transaction, that's been a way to give an added level of comfort to investors compared to other deals that are in the market at the same time and may not have the benefit of some of those features that we're talking about today.
Okay. And how do you see the next 12 months playing out with
It's always hard to bring out the crystal ball and to, have a high degree of certainty, but, I would think that we'll continue to see, the markets are going to be a bit more cautious as they are right now. So I would say that deployment across the secondary market has been a bit more reserved as of late. We may see more deployment as we get into the second half of this year, just because investors have capital to deploy and want to put that to work. And so I wouldn't be surprised if we continue to see, more deployment in a healthy market. I think we are increasingly hearing investors tell us, and they've been telling us for a number of months now, that they'd like to see more multi-asset transactions, even if that's a 2-asset transaction versus a single transaction. That said, we don't see that the market for single assets has really softened tremendously. There's still, for the right assets, for quality assets that have a history of performing through different business cycles and can hold up in a soft market or in a growing market, those assets will continue to capture the interest level of the investors that we're talking to on a daily basis. And we've got a team of distribution professionals that are out talking to investors about our secondary deals throughout the world, really on a daily basis. And, because of the size of our transaction and the breadth of our business, we get very good real-time feedback from investors across the spectrum. And so we feel that we're able to respond and, really work with our GPs and package a transaction that's going to work in a market. We're not in the business of just pushing out deals just for the sake of having additional volume in the market. We really want to put out transactions that are going to be received with a strong level of reception. And we're going to be successful for our clients.
So Steve, it seems like there are a lot of players entering this placement agent business. What's your view on all these new entrants?
Well, there's certainly a lot of groups that have gotten involved on the secondary advisory part of the business, particularly on this GP-led angle where Atlantic Pacific focuses a lot of our attention on. And I think that's not to be unexpected because the market has been growing so dramatically. And in many cases, a lot of the advisors on the M&A side of things, they've recognized that they are potentially losing clients that are coming over and bringing business to a firm like mine, where, essentially we are providing an alternative to your traditional M&A exit process for portfolio companies. And so a number of groups that are involved in M&A may be looking to be able to provide those alternatives. The challenge is, of course, whether they have the investor coverage and distribution. Anybody can call up the most active investors in the secondary private equity world, but really what differentiates a group like Atlantic Pacific is that we cover thousands of institutions globally. We're in every region of the world and every market you'd possibly want to be in. We know the types of investors that fit every strategy that's out there and every down to individual companies and sectors. And that's not something that, every advisor in the market today is able to kind of claim that level of expertise. It's really important to us by having a distribution team of close to 20 professionals globally. They're responsible for knowing the ins and outs of their markets. They know the relevant GPs, they know the institutional investor base in each of those markets, and they're having conversations on the ground in their local markets all the time. And that level of connectivity is just something you can't get by starting up a new business and making a few phone calls. And so at least to date, we've been able to really differentiate our coverage universe and be able to deliver access to the more traditional investors and a broader range of investor types that really have been very positively received by the clients that we take on.
Well, that's great, Steve. I'm glad you're having a great time with your team. Enjoy, have a safe flight back. And when I'm in New York, for sure, we'll hit you up and we'll get together. And similarly, if you're in Houston, please get in touch. And most importantly, I hope that we get to work together again, because it was such a pleasure working with you. And it would be awesome if we get to work on any of those products that you guys have at APC.
Excellent, G. Would love to work with you guys again, and look forward to staying in touch and to seeing you, hopefully pretty soon.
See you soon. Bye-bye, my friend.
Bye.
Hey guys, if you liked watching this video, I think you'd also like these interviews that I've done in the past with people like Anthony Scaramucci of Skybridge Capital, David Rubenstein of the Carlyle Group, Carla Harris of Morgan Stanley, Aswa Damodaran of New York University, just to name a few. We appreciate your participation, and we love the likes and subscribe that you do to the channel, because it only helps us grow and create more content for you. So hope we can continue to do that. And we love having you back, and see you soon.